In 2025, we're due for hopefully the first of several interest rate cuts. Apart from the cash savings, for any loans you might hold, what could this change actually mean for you? Because when interest rates move, some markets can follow. In this episode, I'm going to open up the liquidity and how that's a main factor in the change, the time it can take to actually change a market, and what markets are most sensitive to this change.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Let's get straight into it and talk about liquidity. Now, it's all well and good having low interest rates or even potentially high interest rates, depending on what the main point the Reserve Bank is trying to achieve at that particular time. Now, in past episodes, I've discussed about interest rates and how that is a lever to cool down or speed up an economy, and also the impacts of how low interest rates can impact an economic environment as well. So let's just go back to the basics to start with. A Reserve Bank will utilize interest rates to cool down an economy if its inflation is too high, and therefore they start to increase rates to really slow it down to make sure we have value in our money and wages are real. And what that means by wages being real is we don't want to see wage increases getting eaten up by substantial amounts of inflation in the market. So what you will find is you'll find reserve banks will utilize their lever of interest rates to cool down or speed up an economy. The adverse, if we have very low interest rates, it means we've got an economy that is suffering. Hence, during that COVID pandemic period, we saw the Reserve Bank substantially reduce interest rates because they thought the economy was going to collapse. In addition to the low interest rates at that particular time, we had the government increasing a significant amount of capital into the market, therefore increasing the liquidity. So when we talk about liquidity, we're talking about capital that is sloshing around the markets, money. If people have more money, they can do more things with it. If the cost of capital is quite low, i.e. interest rates coming down, therefore people are forced to move that money into the markets. Markets being property, markets being shares, cryptocurrency, or other tangible or potentially non-tangible assets. So it's important to understand what that money is doing and how much of it is floating around our system. Now, in this particular case, we've had still a substantial amount of money that is floating around the system, although it's been concentrated now to a lot of high net wealth companies and high net wealth individuals. In the past, a lot of people, even your mums and dads running small businesses, were quite cashed up, but obviously during the cost of living crisis that we've been going through over the last 12 to 18 months and a bit of a slowdown, and at the date of this recording, one would argue there's been a recession on a per capita basis, being the individual people. So it's important to understand the Reserve Bank, and again at the date of this recording, our current interest rate sits at 4.35%, which is still much lower than a lot of the Western countries, although those Western countries are starting to bring rates down. So if they do decide to bring rates down lower in the 2025 calendar year, for interest rates to really take effect, and that means improve the economy and speed things up, we still need to make sure there's lots of liquidity. There's lots of capital washing around the markets. And it's not just concentrated to a very small few, because if that is, that's when you really start to see the rich become very, very rich, more so than what they have been in the last couple of years. So it's important to identify that, yes, rates being a lever of increasing or decreasing the speed of inflation, assisting or hurting an economy, it needs to be accompanied with liquidity. And if there's lots of liquidity running around the system, in the banking world especially, then that's when you'll see asset prices rise, because access to capital is important. And with that access to capital, then you'll start to see asset markets increase substantially. So it's just going back to, again, and always looking at the historical data and looking at past economies. If we look at that COVID pandemic period, after we got through the worst of it, we saw a lot of money sloshing around the market, so a lot of liquidity, a lot of capital in people's hands. We saw lending restrictions really wound back, so a lot of people were able to borrow lots of money. Accompanied that with low interest rate, you've got a perfect environment for extreme amounts of asset increases. If you have low interest rates and you've got very low liquidity, you're not really going to see a change. So interest rates as a lever can move the market. Liquidity in comparison with interest rates, that's when you start to see markets move quite quickly. Now, the second point I wanted to discuss is the time it takes to move markets. Interest rates typically, as they go up or down, you generally don't feel the impact of that in the economic environment for at least 12 months. So what we saw was when the Reserve Bank was starting to really increase interest rates at 0.25% or 0.5% at a time, and then lastly with a 0.1% increase, we didn't actually feel the impacts of that because people still had a bit of savings in their bank account that they saved up during those very low interest rate periods. But 12 months on is when you really start to see the impact of the first interest rate increase, and then the second, and then the third. So progressively over the last 12 months, we've started to feel a lot of the pain from those initial interest rate increases all the way to the last interest rate increase. To the point now where I see with a lot of my clients, a lot of their cash savings, a lot of their buffers that they'd built up during those low, very interest rate times, they've all started to be utilised. Haven't got a lot left. In short, now they're starting to really look at their investments they're currently holding and saying, hey, again, accompany this with the cost of living crisis. Do we have the capacity to hold these particular assets long term? Or is it worthwhile for us to cash in and build up a little bit of a war chest and a buffer again? So on the reverse, when we start to see interest rates come down from an RBA level, an RBA point of view, and actually those 0.25s or 0.1s or 0.5% decreases that they may bring into the market, when that starts to really come in and feel the impact of that or the benefits of a low interest rate, we actually won't start to see that for 12 months. Why? Because it takes time sometimes for the bank to adopt an interest rate decrease. It takes time to be able to accumulate the savings from a lower repayment based upon the interest rate you're paying. So generally speaking, guys, if you see interest rates come down, yes, you'll have that bit of euphoric attitude, but when you start to see a decrease of, say, your loan of $92 a month or $100 a month, $150 a month, it could be thousands of dollars per month depending on how much debt you've got, you actually won't start to see a real holistic benefit of that until many months later, because it takes time for you to build up that buffer based upon the savings that you've currently received. So be wary. It's not one of those things that interest rates come down on a Tuesday and asset prices increase on a Thursday. You will start to see that flow in and trickle into the market over the space of about 12 months. You might see from a very early adoption phase, many people go into the market thinking that things are going to change quite substantially very quickly. But keep in mind, the economy sometimes is a very slow moving beast. And they always talk about interest rates being a blunt tool to help the economy. But in saying that, that blunt tool does get to where it needs to be. It just takes a lot longer to hack at that piece of wood. And the last point I wanted to discuss was what markets are most sensitive. Now, again, if we go back to our first point, we spoke about liquidity. Liquidity is very important for assets or instruments that require debt. Property being a major instrument in the Australian economy, but a major user of debt. So typically you'll see that assets such as property, for argument's sake, will be the benefactor of those interest rates coming down because the cost of capital and the cost of funding is cheaper. If the liquidity is there to borrow, we will see the asset market such as property being the benefactor, and that benefactor will come slowly over 3, 6, 9 and 12 months before we start to see genuine increases. However, if liquidity is pulled back and there's not a lot of lending happening in that particular environment, i.e. borrowing capacities are still very tough and the banks are still hurting people being able to borrow money, then we're not necessarily going to see property prices increase. Because if we can't get loans, we can't buy properties, and if we can't buy properties, then we're going to have a supply or demand issue after that. So it's important to understand that, yes, while properties here in Australia and properties being the major asset that people want to invest in, while it's a benefactor of low interest rate environment, again, it needs to be accompanied with good liquidity. If there's lots of money sloshing around the market in the economy and the banks are willing to lend, we'll see properties being the benefactor. Another thing that we start to see as interest rates come lower is the share market start to increase. Again, people start to really see diminished value of return from, say, money in their savings, and then they'll start to move that into the markets, which will produce better yields such as dividends, much better than what the banks are paying. So typically speaking, low interest rate environments, people are hunting around for yield. At the moment, money in the bank, some term deposits are giving around about 5%. Most interest rate savings accounts are probably sitting around about the 3 to 4%. If there's yields from dividends or shares that are producing much better than 3 or 4%, we'll start to see a flow of capital to those markets. Hence, during COVID again, when interest rates were 0.1% from an RBA level or perspective, and money in the bank was getting you nothing, a lot of people were just hunting for any particular investment that could provide them a much better return than, say, 0.1% in the bank. So most assets you'll find that yield-based assets will see an increase in value. Depending on the person's circumstances as well, or the company's circumstances, if there is assets out there which don't have a huge cost of capital requirement, and we'll talk about Bitcoin for argument's sake, and people can use arbitrage. Now, again, what arbitrage is I'm happy to lose this to gain this, and that in between is our benefit that we're receiving. If they can arbitrage, and that hence means pay very low interest rate to potentially try to obtain a larger amount of capital growth as a percentage, then we'll start to see markets or speculative markets like the cryptocurrency platforms or antiquities for argument's sake really going back into a strong market again. So those are the typical asset areas that will start to see benefits from lower interest rates. So just to expand on my prior point about high yielding assets, again, those type of high yielding assets typically might look like commercial properties. It might look like blue chip stocks for argument's sake. It could be even some residential properties that have a bit of a twist to it, such as potentially like SDA housing, or it could be properties that have granny flats, or it might have multiple dwellings as part of it, like blocks of units. And typically a lot of people who invest in those particular asset or areas like to look at the spread. And that spread is, well, what am I receiving as a net yield, a high net yield, of course, versus what am I paying from an interest rate perspective. And if that spread becomes larger, swaying in the direction of more profit, meaning better net yield, versus the interest that you pay, that's when you start to see those asset prices increase. So we saw during COVID commercial property go through a huge boom because the spread between what the net yield was at 5, 6 or 7% versus what the person was paying in interest, which was 2 or 3%. We saw people making money for jam, essentially borrowing 100% of the purchase price of the property and walking away with tens of thousands of dollars worth of profit. The reverse has happened today. Many people even putting down 20% deposits under 80% leverage. By the time they're getting their net yield of say 5 or 6%, they're paying 6 or 7% as an interest rate to the bank. And even when you look at those two spreads, you're not really making any profit. In fact, probably breaking even. So we'll start to see a rise in that asset market on the back of low interest rates. But it takes time. It takes time for that to filter through all the various loan products. It takes time for people to build up deposits again and actually feel the benefit of what that profit and those buffers they've been able to build up generates. So it's important to understand that we've got liquidity as being a major factor with the interest rate movement up or down. If we've got very strong liquidity and we've got interest rates coming down, we're going to see most asset markets do very well. Maybe not initially, but in 3, 6, 9 and 12 months, that's when you'll see a very telling time. If we look at the time, and that comes back to how long it will take for those things to filter through, again, taking liquidity into consideration. If liquidity is just very much balanced and there's not a huge amount of restrictions from a borrowing capacity point of view, generally the rule of thumb is it will generally take about 12 months to really feel the impact of a rate going up or down. And then the key markets to really look at, yes, the residential market will be a benefactor of low interest rates on the basis of very strong liquidity, meaning lots of capital still sloshing around the economy. If it's not, we won't see properties really go gangbusters. Typically speaking, those commercial areas will do very well as rates come down, potentially blue chip stocks as well, as people are really hunting for yield, much better than what they're getting from a banking perspective. And then if rates really start to come down quite aggressively and the cost of funding is very cheap, we're going to see speculative stocks take a real rise again. I don't think we're going to see the price of cars jump up 30 or 40% like we did in the COVID pandemic period. Now, we could see a rise in speculative stocks again off the back of, again, low interest rates and good liquidity as people start to say, yep, my cost of funding is quite cheap. I've got that opportunity in those funds to take that punt and who knows, become the next billionaire or Bill Gates. I'm Jeremy Iannuzzelli, So that's a bit of a wrap up of how interest rates move markets, timing of markets. This is what school should have taught you. Don't forget, keep your eyes peeled for that next episode. Don't forget to hit the subscribe button. If you're listening to us on iTunes or Spotify, don't forget to click follow. I look forward to seeing you next week. This is what school should have taught you.